Hello. Well, this is my second video in the topic of financial planning and analysis for digital agencies. My first video, if you haven't watched it, you might want to go back and check it out, is talking about our process, the process that we, TCA, use for doing financial planning with our clients, for modeling with our clients. And it kind of set out the generic process in that last video. And so now I'm going to talk about in more detail the first component of the process, which is analyzing earnings. I refer to it here as analyzing EBITDA, which is earnings before interest, taxes, depreciation, amortization, and analyzing the profitability metrics, key performance indicators related to income and profitability. So let's get into it. In terms of doing that in the digital agency space, what I want to do is first kind of show you an example chart here, an example spreadsheet that I have. So we're going to put that up on screen as I'm talking. So what you see here is a spreadsheet that is calculating cash flow specifically. So cash flow is ultimately what we're looking for when we build our financial planning models with clients. And actually further down than that, we're actually looking for how much cash do we have available, how much ending cash is in the bank, right? But that's a function of this, what you see here on the screen, which is cash flow. And what you see on the screen here, in terms of cash flow, I would refer to as math. It's a mathematical reconciliation. And so by itself, it's not super meaningful. But really what we're going to be focusing on in this video is the top line of this chart, which is the EBITDA line. That's the earnings line. What I said before, the earnings before interest, taxes, depreciation, amortization, EBITDA. That line has the most significant impact on what's happening in cash flow. If you look down below there, in terms of cash flow is varying, and that would really be our question. Why is the cash balance different? What really causes us to have more or less cash flow from month to month? And the way we would answer that question is we would start at the top of this reconciliation. We'd say, well, one of the factors that causes us to have different cash flow from month to month is if we simply have different earnings from month to month. We have a different EBITDA from month to month. And so that's what we see happening in this chart is we have different EBITDA, which leads to different cash flow. But I think the other important thing to recognize in this chart, and we'll get into these other line items, the meaning behind them or how they relate in a later video. But the thing to recognize is that while EBITDA is a most significant contributing factor to cash flow, it's not the only contributing factor. And what you see there in this chart is changes in AR, changes in work in process. That's what WIP means in that chart. Changes in AP, that's accounts payable. If they have a line of credit, that can affect cash flow. So these are just various common things in the digital agency space that are changing in regards to the accrual accounting and in regards to how you're operating the business. Like when you bill your customers, how quickly you're collecting on your accounts receivable, your AR, that's having an impact here, right? Or if you're doing the work and earning the income, but then you don't bill it right away, you have work in process, and the changes in that work in process account, that also has an effect ultimately on actual cash flow. And so my point in that is that earnings, which we're going to start to focus on, is the primary contributing factor, but not the only contributing factor. So when you're done thinking about earnings, you have to move on to thinking about, well, how do these other contributing factors affect our cash flow as well? So focusing in this video here on earnings, we're going to talk about profitability key performance indicators. So with the profitability key performance indicators, the ones that I would recommend for this industry at a minimum, and I think these are kind of the higher level ones, after you take these, you would often break them down into further components, but kind of the high level ones that I'd recommend are your profit margin. So a profit margin calculated using earnings and in the form of EBITDA. Your profit margin, and when I say that, just your bottom line profit margin in that way based on EBITDA, I mean your profit margin after considering your other operating expenses. So your past gross profit, you've also layered in your overhead and operating expenses. What is your bottom line profit margin? So I think that's of course important in and of itself. I think then Also thinking about your gross margin. If you strip out or you leave out your other operating expenses, your overhead expenses, and you only consider the costs that are variable and, well, I shouldn't say it variable, your costs that are directly related to the service, to the production or the production element of your business in that digital agency, then you've got your gross profit margin, right? So there's some margin that you'd say, well, if you take away overhead costs, you take away shared costs, and you're just talking about, how much revenue do we get from a project and how much direct cost did we have for that project? What is the margin on that? I think that's of course an important key performance indicator. You can look at that for the company as a whole from month to month. How is our averaged out gross profit across all projects changing or trending over time, right? But you can also break this down by project, right? So you can look at it and say, well, if we're a digital agency and we work with multiple clients, we can look at our margin by client. We can look at our margin by individual projects with clients. So those are interesting and important metrics if you want to manage the efficiency and profitability on your engagements, on your individual projects. The other kind of what I'd call the king metric in a service-oriented company is usually going to be your revenue per full-time equivalent, or revenue per FTE. And that metric itself then is driven by other metrics that I would refer to as utilization metrics and realization metrics. Now, whenever you're analyzing EBITDA in this way, from an FP&A side, from a financial planning side, we want to make sure we're coordinating with the accounting process. So analyzing margins requires that you have a chart of accounts in the accounting process that actually segregates direct production costs from other operating expenses. And we believe, I'd say TCA, we believe that for most businesses in the digital agency space, it's best practice that the planning model and the chart of accounts match. It's really not helpful, and it would be, the cost benefit wouldn't be there to be trying to maintain multiple or separate accounting processes or systems, one for actual accounting and one for planning, right? So we think that you should make whatever your planning model is, the line items that you would have for EBITDA or earnings or the income statement in your planning model should be the same line items you have in your chart of accounts, and vice versa. One can inform the other, and if it seems like one is not needed, if it seems like a line item is not necessary for one of these purposes, then you should ask if it's really necessary for the other purpose. Okay, so I'm going to throw another spreadsheet on the screen which kind of carries on the example that we're looking at here. So when you look at this spreadsheet, what we have is a very simplified income statement. So this is not what it would look like in all of its glory if we were doing this with a client specifically, because what we have here is we have revenues, we get down to gross profit, we have some other operating expenses, and then we get down to EBITDA. And you can imagine that, for example, the direct costs, the biggest direct cost in a digital agency is going to be compensation of the people working on the projects, right? But there's probably other direct costs that would actually go in there in that section of the income statement. And then when you look at other OPEX, for example, that stands for other operating expenses, there would be a whole mess of operating expenses that we would have detailed out so that we can plan and track these on an individual basis. But for the purpose of this video and this example, I have it all kind of summarized here in a smaller version for us, and I think that's fine for kind of thinking about how we look at some of these metrics. So when we look at this chart, what I'm showing is a calculation based on the last spreadsheet of the profit margin. So this is, or I just refer to it as the EBITDA percentage, right? So this is EBITDA divided by revenue, and what it's showing is the bottom line after OPEX and overhead expenses. Here's where we are at in terms of our total profit margin, essentially. And we see that it's moving around a bit here. Okay, and now in this chart, I'm showing the gross profit margin, and so that's why I'm abbreviating their GPM in the chart, or gross profit divided by revenues. And here we see that the gross profit margin actually isn't jumping around quite as much as the bottom line profit margin. Let's talk about those are the basic calculations of a bottom line profit margin and gross profit margin, and it leads to a thought process of, okay, well, is it that our project profitability is varying, or did our OPEX vary, right? And our OPEX varied a little bit, so that affects this. But now if we think about, if we want to ask, well, why did the gross profit margins vary? That becomes a question of individual project profitability. So I'm going to switch over in thinking to think about the importance of what I called one of the king metric for classic service providers, and that is revenue per full-time equivalent. And why, when you look at that and you say, well, why is that a king metric? Well, because when you ask this question, what is the key driver behind gross profit margin, right? When you look at it and you say, why is it that our profitability across jobs it has a variability in it there? What's causing that? What drives our gross profit margin? Well, you can express what really drives your gross profit margin. In most cases, you're going to express that effectively, or efficiently, I should say, as a function of your revenue per FTE. And the reason that I focus on revenue per FTE is because if the cost element of your gross profit margin is people, your production salaries, in a lot of the digital agency environments, the cost of that is fixed in the short term. It's not really like you can say, well, we're going to improve our profitability on next week's project by paying Tom less money, right? Or we're going to ask Jane to just, not work and not get paid next week so that we have fewer people and we improve the profitability of our jobs. That's usually not a viable thing to do. And so really the piece that you can more realistically plan and control is the amount of revenue you're generating per FTE, which is an indirect measure of cost as well, because if the revenue per FTE is not enough, it's either because you're just not generating enough revenue, or you just have too many people. So over the long run, you can look at that metric and say, well, if my revenue per full-time equivalent is declining, maybe that means I need to have a lower head count, right? Or it means that I am committed to keeping that head count and I need to get out there and sell more and I need to bring more revenue in. It means one of the two of those things essentially, right? But there's other more specific production and efficiency metrics in terms of that go into revenue per FTE that I want to talk about in more detail here. So when you look at this spreadsheet of revenue per FTE here, I've made up data here where we have full-time equivalents that are working in production, 20 people, and 21 people. And then I'm showing, okay, you could in theory look at gross profit per FTE. That's a metric you could calculate. But my point is, as that might be interesting, it's harder to plan the gross profit itself because that incorporates both the revenue and the cost. And the case I was making earlier is you're probably not planning the cost side of this in the short term. You're not deciding to pay somebody more or less on a per job basis in most cases, right? So the average cost per FTE kind of stays the same. And so really the variable factor here is not your average cost per FTE, but your revenue per FTE is the variable that you have. There's some planning that you can do on that point. So there's two levers to revenue per FTE. I mentioned earlier that we can talk about efficiency metrics or efficiency measurements that kind of help you understand and lead toward what's happening with your revenue per FTE, why it's going up or down. And the two levers are what I would refer to as utilization and realization. And when you look at the lever of utilization, what you're classically looking at is the number of production hours per FTE. So how many production hours did you have per FTE during a period of time? That is a measure of utilization. The more production hours you had per person, the higher utilization you have. The less production hours you have per person, the lower utilization you have. And when you think about it in a professional service environment, what is it that will affect your production hours per FTE? Well, I mean, it's not the number, because you're doing it per FTE. It's not the number of FTEs that affects this metric, right? It is how much work each person's actually doing. And specifically when we say production hours, what we mean in in a service environment is how much billable work is a person doing. So what can affect the amount of utilization first and foremost is, are they bogged down or involved in or otherwise responsible for things that aren't production related? Perhaps they're working full-time or overtime the entire month, but a lot of that work is spent on things that don't directly aren't considered by your organization to directly add to revenue, or aren't production related, aren't being billed to a client per se, right? And classic examples of that would be training or some kind of supervisory activity. Maybe these same people who actually are involved in production are involved in the management and administration. They're involved in the accounting and billing processes across your clients or whatever, right? But these kind of admin tasks, the mentoring, the training, the all of that, these things become what we might think of as just admin. They're not production related, and they're going to detract from your utilization per person if you have a lot of administrative non-billable work going on during that period. So that's that concept of utilization. The other piece of it could be that you have a full-time equivalent, but you owe them some vacation, or you owe them, or they're sick, they have some sick time off, or whatever that may be. And so that may be that you consider them to be on the clock full-time, but their production hours are lower than you would expect on a normal month because they happen to be gone for 2 weeks on vacation. That's going to affect the amount of utilization you're getting per person as well, when you think about this concept of how many hours are we per person are we actually putting to direct productive use towards revenue that lead to our revenue per hour. So the second metric aside from utilization is the revenue per production hour. So we look at revenue per person, right? That's our revenue per FTE, and we're saying, well, that's driven mathematically by your utilization, which is your production hours per FTE. And the other determinant mathematically then is simply your revenue per production hour. And I say that mathematically because when you put that into an algebraic equation, and I won't put that on the screen. Well, I will. Let's put that on the screen. So now that I've got this on the screen, when you look at it, the star symbol there is a multiplication symbol. What I'm saying is this is actually a mathematical relationship, it's not just an intuitive or qualitative thought process that I'm making here. It's a mathematical relationship, right? Your production hours divided by your full-time equivalents, your production hours per FTE multiplied by your revenue per production hour, that actually equals your revenue per FTE, right? So I'm just breaking the revenue per FTE into other algebraic fractions, and then I'm putting a qualitative description on those other algebraic fractions, right? So I'm saying that the algebra, if you kind of step away from the math of it, what that means is the amount of people that are being utilized, or the amount of hours that people are being utilized, the amount of hours per person that you're getting utilization. That's our utilization piece. And the part that I'm referring to as the realization piece is the amount of revenue that you get per production hour. So in this example, I'm showing you on this chart the way this example works. I've thrown up there arbitrarily, and we could probably debate whether these hours are realistic for these particular months, but I've thrown up there just kind of an arbitrary. The paid hours per FTE is assumed to be 173 per month here. The production hours each FTE works varies. Production hours per FTE is averaging out here to 104 in one month, 100 another month, 110 in another month. So, and then the remaining hours, the implication is the remaining hours are the time that people are spending on average on admin functions, right? So I'm expressing this concept here of utilization as a percentage. I'm saying the amount of hours spent production to the total amount of hours they had available is 60%, 58%, 63%. And we can see that would affect our revenue per FTE in those months, which would affect our gross margin on the financial statements in those same months. Okay, so in this chart for realization, what I'm showing is here was the revenue per FTE, and we know that if the revenue per FTE varies, then the gross profit is going to vary. And I just mentioned earlier that one reason our total revenue per FTE varies as our utilization would vary. But now what I'm showing is, well, if you redo this math to figure out what the realization rate, right, the amount of revenue that you're actually getting per production hour is, you can see that the average rate per hour is changing here, right? It's 240 in one month, 230 in another month, and 225 in another month. So the moral to all of this, of what I'm getting at, is that is that in any given month, you have a different level of average utilization of the production staff. You have a different level of how effective on a per hour basis they are in terms of revenue production, that realization, right? So that combination of the realization with the amount of utilization is really what drives what's happening with your revenue per FTE, which, if you back that up, that's what drives the changes in your gross profit margin, which ultimately drives the changes in your bottom line profit margin, which ultimately drives to what we're always looking for, what's causing the changes in cash flow. Okay, so circling back in here, let's talk about realization, because realization, when you look at it and you say, okay, realization is measuring this rate per hour, this amount that we can get in revenue per production hour. And we see that it's going down in this thing, and that might disturb us. And we were thinking, well, how do we manage this? How do we improve this? And I think the cynical view on realization is, well, realization is an efficiency metric, and the way you're going to improve it is by getting people to just get more stuff done within an hour. Yes, that's true, right? I mean, if you are able to essentially get more work done within an hour, then you can get a higher rate per hour. Presumably, at some point, somehow in your business model, that should become true, that you can get more revenue if you get more done in an hour, right? So that's certainly one possibility, is that it's about improving the efficiency of, or the effectiveness of, your team, so that they can actually get more done and command a higher rate per hour, because they're simply doing more in a specific hour. They're doing more tasks, they're accomplishing more objectives, and so on. But let me present an alternative thought, which is that that isn't the only path to improving realization. The other path to improving realization is that you're not actually doing more things, you're not actually achieving more objectives. It's that the objectives you are achieving are actually just worth more, right? If the value of your objectives was higher to begin with, you would have better realization, you would be getting a better rate per hour, better realization as well. And so I think that rather than constantly thinking about, well, how do we just grind more out of our team, I would encourage any operator to kind of think about the other side of it. How do we increase the value of our team? Not just because they can get more done in an hour, but because the inherent value of the tasks, the objectives, of the stuff that they do is just worth more. That is an alternative path, the path I would prefer to walk down in terms of improving realization. So this point about kind of the two levers of realization that I'm trying to make is it's not just a qualitative or an emotional appeal here. I'm actually breaking it down for you here mathematically as well. If you take the revenue per production hour, the algebraic determinants of that is the quantity of work per hour multiplied by the value per quantity of work, right? The value per item of work, right? So it's not just how many items of work you get done, but it's the value per the item of work you do that determines your realization, which ultimately is a determining factor along with utilization of your revenue per FTE. So I just wanted to share that, because I think sometimes people hear these things and they're like, oh, those are nice platitudes, or those are nice ideas in terms of how to run the business. But what I'm trying to tell you here is that it's not just a conceptual idea from that standpoint. It's mathematical, that yeah, if you can increase the value, you will increase your realization. And that may be intuitive to you, whether you understand the algebra piece of it or not. Okay, well, there was a lot there to unpack. We were talking about kind of the basic profitability, EBITDA metrics that I would focus on in a digital agency environment. There are certainly more. You can take any of those metrics that we talked about and you can disaggregate them or drive them down to more levels of detail. But those would be the basic the basic metrics, the direction that I would go, because those metrics tie into the actual financial statements. And from there, I think you can break those down into further metrics that make sense in your particular business, that that you can track for operating purposes. And yeah, I think I'd love to hear different ideas of things that people track. Please maybe put them in the comments, things that you track or things that you thought about tracking and how that might work. And besides that, I'd love it if you are enjoying these videos and you're getting value out of watching them, if you would subscribe to our YouTube channel, and if you would like us and share us with your friends and colleagues, that would be outstanding. So that's it for this video. In the next video related to this series of financial planning for digital agencies, we're going to focus on moving from analyzing profitability to analyzing cash flow and looking at the cash flow specific key performance indicators. Okay, that's it for now. I'll talk to you guys next time. Take care.